Okay, we'll call the meeting to order. And this evening is our study session for the City Council held on October 5th. And here we are. Our really only order of business for the evening is to receive a presentation on the fiscal year 2015-16 annual audit from our auditors, Plant Moran. Pam, are you going to start off?
Sure. All right, well, thank you. I don't know. Is this on? Or?
Yes, it's on.
Okay. Thank you for having us here this evening. Since we are the only thing on the agenda, we'll make sure we go page through page of the financial statements.
We're anxious to have that happen.
But really, our team's out here. We spend approximately 250 to 300 hours annually auditing the books and records of the city. We did want to thank the treasurer and the city administrator, as well as the staff. We are out here for a week, and we know they have to get their daily tasks done as well, so we do appreciate the time that they spend with us, and also all the time we know it takes to get ready for us to come as well, so we do appreciate that. We have 3 documents in front of you today. You have your financial statements, which is the thick copy. That's about 50 plus pages. So we will not pull through that in detail. We do have the graph presentation, which is going to give you a high-level view of your financial statements, similar to what we've done in the past. So Ollie's going to cover that at a high level. And then also we have the letter to the council, which I will cover as well. I do want to point out in the financial statements, just 2 pages 1 and 2. That is the opinion letter.
Just coincidental.
Yeah. So that is what Plant Moran provides to the city. It was an unmodified opinion this year, which is the highest level of assurance that you can receive from your auditors. Basically, what that means is that the numbers as they are presented are free of material misstatement. So it doesn't speak to the financial condition at all of the city. It just speaks to the numbers at June 30th, 2015. And so again, Ollie, through the graphs, will talk about the financial position and condition of the city. So with that, I will turn it over to Ollie, and we'll go from there.
Pages intentionally.
So each of you should have a copy of the slide presentation in front of you. And so we're going to walk through the financial highlights, and definitely feel free to stop me if you have any questions or would like to talk about anything in greater detail. The first couple slides focus on the governmental fund revenue and expenditures. So this would be revenues and expenditures for the city's general fund, major local street funds, and the capital project fund. The first slide, governmental fund revenue, breaks out revenue for the last 4 fiscal years based on the major categories. And so on balance, you'll notice that with some variation, revenue is on par with where it's been in the most recent past. Came in total about $4.3 million, $4,340,000 for 2015, which would have compared to about $4,366,000 for 2014. The biggest item of governmental fund revenue for the city is property taxes, and we have a few slides that'll dive a little bit deeper into what's happened at the city in terms of property taxes over the last several years to help put that number in perspective. The next slide walks through the other side of the equation, governmental fund expenditures for the last 4 years. The first thing you'll likely notice here is that there was a large reduction in governmental fund expenditures from fiscal year 2014 to 2015. Expenditures were $5,246,000 in 2014, and in 2015 that number was $4,203,000. And the biggest driver of that reduction is that in fiscal year 2014, the city made the decision to fund its unfunded pension liability. So that expenditure, about $1 million, was reflected in fiscal year 2014. A small portion of that was in the water and sewer fund, which isn't included in these slides, but most of it is in the governmental funds because that's where the expense is incurred. And in terms of individual line items, most of it is in the governmental services line, and there's a portion of it, about $250,000 or so, that's in the public safety line. So that would be the biggest change. Those would be the biggest changes in terms of your governmental fund expenditures. This year, we also helped the city implement a new accounting standard, GASB Statement Number 68, and we've been talking about that for a number of years. GASB 68 essentially changed a little bit how the net pension liability is calculated, and then requires governmental units to actually put it on the books. But it doesn't go on the books at this level, at the fund level. It goes on to your government-wide statements, which reflects capital assets and your debt. All the long-term assets and liabilities go on the books, and your net pension liability is recorded there. When Pam gets into the letter, she'll dive a little bit into that number and what happened this year. But just want to bring that to your attention in case you were aware of GASB 68, because there's been a lot of talk about it. That was also implemented this year. The next slide is a slide that we've historically presented that talks about the timing of property tax decreases. Essentially, when taxable value decreases, when does that get reflected in the city's budget year? So the first line will show the budget year, the second line shows the assessment date, and then the third line shows the levy date. And this slide shows, at the time that property values were falling, there wasn't you didn't immediately feel the impact of property tax, your revenues declining. This slide illustrates that, but what it also illustrates that we'd like to point out is just how much the city's taxable value dropped from the period. It's actually from 2008 on to 2014. It was really a collective reduction of about 39% of the city's taxable value. Now, what this slide shows is you may have noticed your property tax revenue increased slightly this year. So property values are now starting to recover in most communities. But because of Proposal A and Headley, the way those function together, those increases are going to be limited to the lesser of inflation, or 5%. And inflation hasn't come really near 5% in a number of years. So this slide illustrates that, and then the next slide shows what you can expect from how long it would take your property tax revenue to recover. So this slide illustrates in the city's actual numbers what happened from 2008 to about 2012, 2013, and the pace at which the city's property tax revenues declined during the economic recession. And now, if you assume, 2015 would show your actual inflationary increase, about 0.9% in taxable value. And then 2016, you're anticipating about a 2.3% increase based on some preliminary numbers. But if you assume a 2% increase into the future, you can see just how slow it'll take for the property tax revenues to increase. And if you take this graph out, you probably wouldn't get back to 2009 levels until about the early 2030s.
Right.
So to put that in perspective, and Ali's going to cover, I think, in a little bit, I think a slide or two, your fund balance and where the city is today. When you look at this and you see the 40% drop in, like Ali said, your main revenue source, I think the city really has done a very good job at looking at these revenues, forecasting out, and then adjusting your expenditures accordingly. Most businesses would never be able to survive on a 40% decrease in their revenue. So the fact that you really have been able to maintain and weather the storm, I think, really shows a lot about council management, the employees, union groups, and so on, and how everyone's kind of had to work together to weather that storm per se. And unfortunately, we're not here to give you any good news, and I know you already know that as well. But it is going to take a long, long time, so it's really pretty much reset the level that you're going to be at. There is, this is the new norm at this point, so unfortunately.
Right. So Pam's right, we will get to the fund balance. I have one more slide before we get there. It kind of shows the other major revenue source for the city, revenue sharing. And so over the last 15 years, up until maybe the last few years, revenue sharing was being cut, the statutory portion. And what this slide demonstrates is where revenue sharing, the top line, the straight line would show if revenue sharing stayed constant at what the city received in 2001, and then the line beneath that shows what the city actually received. And if you just assume since 2001, if we would have gotten what we had gotten in 2001 versus what we actually got, what is the cumulative loss? It's about $1.9 million. So to Pam's point, between the property taxes and what's happened in revenue sharing, the city has done a good job of managing its expenditures. And
To do a fair amount of infrastructure work, more than we were able to. We had that money.
right. No, that's exactly right. And so that brings us to the next slide, which is the general fund balance. So the general fund responsible for the general operating expenditures of the city. And what this slide demonstrates is it shows what are your annual expenditures and how does that compare to your assigned fund balance. And the city is always targeted to have at least 20% of its annual expenditures set aside in assigned, non-restricted fund balance. And the city's been able to successfully do that. Even when you use the elevated 2014 numbers, you were still able to put 20% of your fund balance into that assigned bucket to basically say we are the city's on solid financial footing as it relates to its current level of expenditures. So that's it for the financial highlights. I'll turn it back over to Pam, who can get into GASB 68 and everything else that's in the letter.
I did want to point out, too, that in relation to the general fund this year, you did increase general fund balance by about $28,000 this year. So I know we went over the revenues and expenses and the fund balance graph, but there was a positive increase in fund balance. You actually budgeted, your amended budget was to use about $63,000 of fund balance, so you did come out about $90,000 to the good, mainly on the expenditure side, being able to cut expenses, a little bit on the revenue side, but the majority of that was really paying close attention to the expenses, monitoring them. And your budget variances, I have to say, and we talked about this a little bit at the draft meeting that we had with management, and to be so close to your budget where you came in, you can tell that you're really using the tool appropriately, and you really have a good budget document that you're working with throughout the year to be able to get that close to where you budgeted. I think is a true testament to actually utilizing the budget process appropriately. So I just want to point that out as well. Okay, if there are no questions on the financial statements, we'll take a look at the letter, which is the stapled copy that you have. So there's 3 sections to the letter. The first one is the internal control related items. That starts on page 3. Actually, I think it is only page 3. Yep. And so this is the same thing. There were new auditing standards that were implemented many years ago, I'm sure most of you remember, that required us to kind of lower the bar as to what we are required to report to those charged with governance, which in this case would be the city council. And so we did have a few journal entries that we posted as a result of the audit. As a result, we are required to let council know. However, we would like to say that the majority, actually all of the entries, were entries that related to year-end adjustments only. So it's kind of something that you do once a year, timing type related items. So the integrity of your day-to-day financial statements is not in question at all. The numbers that you get on a monthly basis to review your budget to actual statements, those are all good. The processes that you have in place for those numbers and the internal controls surrounding those numbers are in very good shape. This is, and we see this at probably 70-80% of our clients. This is really a result of the fact that you're just a smaller organization, and so you kind of have to do with what you have, and a lot of times there's not the ability to have someone knowledgeable to do a second review of all the stuff that happens at year end. So there is a lot of stuff that goes into that. I think your team does a very good job at reaching out to us during the year with questions and when odd things come up. And actually, your internal team did all the GASB 68 work. We assisted a little bit, and we actually had a toolkit that Plant Moran provided just to clients only, but I think helped a little bit through the implementation of 68, but they did a great job with that. So again, really, I think if there was the staffing to have somebody be able to do a second review, some of these minor things could have got caught. But at the end of the day, it really just relates to year-end adjustments only. So I don't know if anyone has any questions on that.
Anybody?
Okay, then next pages 4 through 6, this is the required communication under the auditing standards. If you'll recall, at the beginning of the audit, usually we talk with the mayor, and then we also send out a letter to the rest of council, just kind of with what our plan is going to be for the audit. And it gives you, as council members, the opportunity to reach out to us if you have any concerns that you want to be sure that we address during the audit. So this is the follow-up letter to that, and just kind of talks about what our plan was and how our plan went, and if we had any deviations from the plan, we would note them within this letter. We did not have any deviations with the plan, and there was nothing to note. The one item we did want to discuss, though, was related to GASB 68, as Ali pointed out, and the recording of that pension liability on your financial statements. And if you have your financial statements with you, if you could turn to page 36. I did want to just touch briefly on this because the city did, last year, as Ali mentioned, put forth a large sum of money to help with the pension liability. And as of December 31st, 14, which is your measurement date, that's when MERS does the actuarial valuations, you were about 90% funded, which is excellent. That's higher than, I think, almost any community that I work with. I think there was a little surprise this year that you did still have a net pension liability. So if you look to the far right column, there's the net pension liability up at the top was about $776,000. The thing with GASB 68 that is going to be a little bit different than what you're used to seeing is that they measure your assets in the plan based on what the fair market value is. So in the past, it would be smoothed. So if you had, a big fall in the market like in 2008 and you lost $1 million, that $1 million would be smoothed over 4, 5, some cases 10 years, but I think you were on a 4-year smoothing. So you really wouldn't feel, the purpose of that is so that your annual required contribution every year isn't bouncing all over the place depending on what the market's at. For purposes of reporting the net pension liability, the GASB standards require that your assets are based on fair market value as the date of the valuation. So every year, this number is going to fluctuate up and down, up and down. Now, for purposes of for calculating your annual required contribution, you're still going to have that smoothing. So that won't be an issue, I think, from a budget perspective. But from just the perspective of what does this look like in your financial statements, that's why it looks probably maybe a little bit higher than what you thought. Now, at the end of the day, you're still very well funded. You're still, I think, you made a great effort at working towards this. And on an actuarial valuation method, you are higher than 90% funded. So looking at that perspective, that is going to affect your contributions. Your contributions should go down, which was the point, so that your budgeted numbers and what you have to pay out of the general fund every year will go down. This is, I hate to say, it's just more of a complying with the accounting standards look at it, but this is just a snapshot, one point in time, whereas the actuarial evaluation realizes that you're not going to have these changes in the market, and it is going to be more smoothed over time. So I don't know if anyone has any questions, if that makes sense, but I did want to point it out because I think initially even we were like, well, why do you have a liability? You just made this huge contribution. But
Right.
Then once you look at the way the accounting standards account for it, it's just a little bit different than what you're used to seeing in the past.
And I could just the only thing I'll add to that is, I know my clients that have made large contributions to get their funding percentage up. I mean, it's always gonna shift, not just because of accounting standards change, but, you know, you get new assumptions, new mortality tables come
Yeah,
out.
that
These different
changed.
assumptions is always gonna, some of them will help you, some of them will hurt you. But if you're in the ballpark, and if you've got a 9 in front of that
Yeah,
number,
that's-
that's pretty good.
That's great, yeah. Okay, and then lastly, on page 7, 7 and beyond, we have a few legislative updates, some informational items. I wasn't going to take the time to go through all of them. I know that you've had these for a little while, so you've probably had a chance to read through it. Some great news is GASB has some more standards for you. And what they just required you to do for pension, you're going to have to do for OPEB and your other post-employment health benefits liability, you're going to have to do in a few years. The good news is you've already sort of started recording some of that liability, so it's not going to be as huge of a hit. But it's just going to be one more thing for your limited staff to do, and probably some more money for actuarial evaluations and things like that. So just something to keep on your radar. I would like to say, and I know you don't go out for bonds all the time, but a big concern is like, well, how is this going to affect our bond rating if we do go out for bonds, so on. The bond rating agencies have known all along that you had a pension liability and an OPEB liability. So from what we've seen with all of our clients, this is not going to affect bond ratings at all. Like I said, they all knew those were there. Now they're just on the front of your statements and easier for them to see. But in speaking to the bond agencies, that does not affect bond ratings at all. So really, again, it is more just a accounting thing, I hate to say.
Now, Pam, you deal
Yep.
with that on page 40 on our report.
Yep, so that's your other post-employment benefit. Currently, you do have an unfunded liability of about $4.4 million. And at this point, there hasn't been a funding mechanism that's been set up by the city to help pre-fund these liabilities.
Now, you say when those standards go into effect, though, how does that impact us as far as that 4.4?
So it should be relatively close to that amount as far as the liability goes. We don't have a lot, it's just it newly came out, so we don't have a lot of information yet as far as any odd reporting changes or how they might make you calculate it, things of that nature. But it will, at this point, you could assume that the liability there would be about between 4 and 5 million. The GASB accounting standards do not require that you fund this liability. It's merely a recording thing. So just to make that clear, your pension, that's a state law. State requires you to fund it. GASB can't require you to fund anything, but it will get put on your balance sheet again as
But that number is
outstanding
put
liability.
together based on something.
Yes, so currently,
So what do? They try to figure out what these employees are going to be owed in these
Yes.
types of benefits by the time they're eligible to.
correct. It also looks at if you have beneficiaries that
So
are
we've
in
been
the
chopping the
plan.
heck out of those post-employment benefits
Yep.
over the past several years.
Yeah, and your plan is closed, so if there is anyone else new that comes in, barring any huge changes in healthcare rates, you shouldn't see that number really spike at this point. But it's all based on estimates. I mean, it's based on longevity and things like that. And
Right.
I mean, those are all, as you mentioned, Mayor, those are all estimates, and it's kind of like a best guess, at that point. So, and it is based off healthcare trends, which your team gets from your healthcare providers as far as what increases may be in healthcare and things like that.
How do we compare to other communities as far as this unfunded liability?
So, I mean, because you are smaller in size, the dollar amount
the
is
dollar amounts,
smaller.
but
Yeah.
are-
I would say probably there 40 to probably closer to 60% of communities are not advance funding their post-employment health benefits. We have some older communities that have been funding forever. We have some that started funding, and then when the times got tough in '08, started using that money to pay their current obligations. So now they're back down to not funding. We do have some communities that have been fortunate, and they have been able to, over the last several years, we've seen more of a push to start setting aside money within the retiree health care and setting up funding vehicles for that. Especially we've had a few, and you know, Ali can testify to what he's seen on his clients, but I've had a few clients where, like I said, they've been fortunate to have excess fund balance, and realizing that this is a real liability, they have set aside money and have started using different funding vehicles for the retiree health care, just because the interest rates have been so low and what you can earn in your regular cash accounts under Public Act 20, that they're able to invest in different things with this money. So they have been saying, all right, well, given these interest rates, let's move some of this excess cash over to a vehicle that we have a better chance of making more money on in the long run. So I have seen a little bit spike in that because the interest rates have stayed so low for so long. I don't think anyone really would have said 7-8 years ago that today we'd be standing here with the same interest rates as we did 8 years ago. But unfortunately, that is the case. So I don't know if you've seen anything different at yours.
Yeah, I
but
mean, I agree. My clients, you know, those clients there's definitely more discussion around how do we tackle this obligation and trying to figure out the best way to do so. But the memory of kind of the reduction in revenue is still kind of strong. So there's a little bit of being very strategic and deliberate about it. Some communities have gone out and, you know, bonded for liability, but that comes with its own set of risks. You know, if you bond for it.
Didn't Oakland County do that?
Yeah, so
They bonded for some of this risk.
yeah,
Yep.
some of the counties have done that. You know, and then they acknowledge the risk of, you know, you put the money into the market. If you do it on a bad day, you have a bad first year, you know, then you end up with a debt service payment and a required contribution. So it's something where I think at least my clients are looking at all of their options based on where their fund balance levels are, and what options are available to them, how much they're contributing, and the type of plan that they have in their population, what makes the most amount of sense. But it seems like most of them are at least talking about it.
And as you know, it's hard to balance because you have had to put off so many capital things for so long. So it's like capital, other benefits that we've promised, pension, OPEB, so on. So, you know, looking at certain projections, maybe looking out 5-10 years, doing something like that, maybe on a high level. If you are trying to kind of decide, like, well, here's the list of all the things we need to do, where's our priority and where do we think we can afford it, something like that might be beneficial when you're trying to decide what to do with any excess that you may have. Looking at a capital plan, how far out are you on those types of items? What's an emergency? What can wait? Those kind of things really can help you make, I think, those decisions if you are looking at pre-funding or advanced funding your retiree health care.
Thank you.
Thank you.
So with that, I don't think there was anything else really significant within the legislative items. Some of these are a little old because we were dated about a month ago, but there are some new requirements coming up, as always, to the state and different things like that. You know, revenue sharing, Ali talked a little bit about. We actually have seen a little bit of an upturn in revenue sharing, as I'm sure you know.
Yes.
Sales tax collections have been up, and then the state has been giving a little bit extra, I think, the last 2 years. Of course, you've had to do a little bit more in order to get it, but they have kind of increased that pot a little bit and given communities a little bit more, even with Act 51 money within the last year. So we are seeing a little bit of an uptick on that, but it's definitely not anything substantial. It's not like you're seeing even a 5% increase. It's very nominal in comparison to the increases in your expenditures. So is there any other questions or anything we can help you with today?
Anybody have questions? Any other questions?
No, I'm gasping out.
That four-letter word. Of course, as always, if you have questions during the year, we're more than happy to come back at any time. Or, you can contact Ali or I during the year if you have any concerns or questions that we could help you with.
Thank you.
Thank you very much.
Thank you.
Appreciate you coming, as always.
Yes, thank you.
Your clarity and explanation, it's always nice.
Thanks.
Is there any other business come before this group tonight? Motion to adjourn,
So moved.
second.
Second.
All those in favor, please say aye.
Aye.
All opposed? This student meeting is adjourned. Thank you.